Tonight we are finally going to go through our market crash case studies. It's been pretty interesting putting a lot of the information together. Certain things that I expected to see and certain things that were a bit of a surprise. So, I'm going to divide this up into two parts. Tonight we're going to spend a lot of time understanding what market crashes happened, some of the summary statistics of recovery time, and then looking at each one of those major market crashes. And we'll talk a little bit about some of the key takeaways and ways to mitigate against those crashes. And then we'll spend a lot more time next week talking about the actual mitigation techniques because I think that's a pretty fulsome discussion as well. And I don't want to feel like we're running short on time when we're covering this topic. So that's what we'll focus on tonight. As we go through it, or before we get into it, let's do good news. Spencer, you want to start us off?
Well, my oldest son is traveling out west, so he has been, yeah, he's by himself. He's camping out by himself in Glacier and then Yellowstone and the Cascades. And so far, he's alive and well, so that's a good thing.
That's a
So
great thing.
he's got some great pictures. He's texting us, when he's in cell range, which isn't real often, but
Yeah.
looks, thankful that he's able to get out there and have a good time with that.
Good. Vladimir.
As I said, I made 5,200 miles
Hmm.
moving from coast to coast, making side roads to visit friends, and I made it.
Hmm.
And it was very enjoyable trip.
Yeah,
I wish I will be a writer. There are so many stories to tell about different families and what they go through, happy and sad. So it was
that's cool.
very interesting adventure.
Yeah, there's a lot to see in this country. I did a cross country trip after college, and there really is a lot to see. That's neat that you got to do that. Um, James,
Good evening.
representing Brooklyn.
I am representing Brooklyn today. Um, the I thought I had good news, but it looks I just now looked at the calendar and it actually doesn't miss. My half sister is getting married in Dallas, Texas, and I thought it was the 12th of October,
Oh,
which I was going to package with the SOS live event,
yeah.
but I literally just looked at it and I got the dates wrong, and she's actually getting married the Sunday prior, the 5th. So I will not be packaging those events. So I don't know. We'll see what I do.
All right. Rajan.
Hi, Robbie. So Monday I changed my job to a newer new vendor company. So and hopefully it will go well longer. Also, I'm getting a little bit more money. So
Nice.
that's a
Good
good
stuff.
news.
Very good. Shannon.
I would say good news is I got my portfolio set up with your strategy and I'm watching all the archives. And overall, I'm just abundantly happy to have free time again.
Nice. Don.
Well, I interviewed a dog sitter because I'm going traveling in 2 weeks, and my other one bailed on me. So anyway, so now I have a very successful sitter because my dogs are spoiled rotten.
Nice. There you go. All right. Let's see, my good news. I am going tomorrow to Chicago. I'm gonna drive there with my kids, and I'm gonna go meet my niece for the first time, who's about a month and a half old. It's my brother's first kid, so that'll be pretty cool. Excited. And then my kids start their school on Monday, so it's crazy that summer vacation is coming to an end here for my kids. All right, we're gonna get into it. By the way, for this one. I'm gonna record it like I always do. I'm also considering uploading this to the Vitality Trading YouTube channel, but I think it'll be a really interesting discussion that, I think a lot of others can benefit from as well. Just wanted to give you guys a heads up on that. So I'm going to share my screen and we will get into it. So in terms of time period, I took a look at market crashes over the last 50 years, right? So really since like the mid 1970s. Um, some of the key initial takeaways are, and just how I'm defining it, is there have been about 16 market crashes over that time period. And the way I'm defining a market crash is any time the market declined by more than 10% within a single month. And I'm really looking at the S&P 500 here. There are certain times, certain crashes where you could have multiple months where the market went down by more than 10% in a single month, which I'm not counting that as a separate crash. It's just part of the sort of the broader crash. But there are kind of 16 unique events that caused crashes over the last 50 years. The causes of the crashes, I've bucketed into one of five categories for each one of the crashes. It could be global trade disruption, right? So something where people are worried about global trade being impacted in a significant way. It could be broader inflation concerns and rising interest rate environment. It could be an algorithmic trading event, right? So something that had more to do with high frequency trading or, just something that was triggered by technicals. Contagion risk from a significant event. And so that I'm talking about something happened either in the market or in the world that isn't necessarily directly related to equities, but where people are worried about broader impact from that event. And then lastly, looking at things where you had market bubbles. So, and we'll go into examples for each one of those to make sure you can understand what I'm talking about for each. And then our discussion is going to really focus on the frequency of these market crashes, the amount of time it takes to recover from these crashes, how the cause of the crash impacts recovery time, and then lastly, strategies to mitigate the impact of market crashes in our portfolios, which at the end of the day is the most important. So, starting with some summary statistics here. Um, so when you look at the number of crashes by decade, what you'll see is it's pretty consistently, 2 to 3 crashes. There was one crash in 1978, which I didn't include here, but you have in 1980 you had three, 1990 you had two, in 2000 you had two, and you'll see in 2010 decade we had 5 crashes, and we're only halfway through the 2020s and we've had 3 crashes. Right, so there have been certainly an increasing frequency of crashes. And when you look at the amount of time to recovery, you'll see I have sort of the minimum amount and then the maximum amount of recovery by decade. And you can see there's a standout in the 2000s because we had first the dot-com bubble and then we had the 2008 Great Recession where there was a huge amount of recovery time. And then, in the other decades, it's been much shorter. In the 2020s, the longest one we had was during the concerns about when inflation first started impacting post-COVID, and then you also had the Ukraine and Russia war. In the 1980s, the longest one was related to the Black Monday, which is really an algorithmic event. But then otherwise, you can kind of see where that's fallen. In terms of crash recovery time, you can see that. I'm trying to visualize this. But you can see that there were 5 crashes that were less than 3 months to recover, right? Very, very quick recoveries. And then there were, another 6 that were between 3 to 12 months. And really, if you were to dive into this, I don't want to create a separate category, but 5 of these 6 crashes were actually recovered in less than 6 months. And there was one that took closer to 12 months. Um, and then you had 3 that were between 1 year and 2 years. Then you had the two that were greater than 24 months. So, overall, of the last 16 crashes, 10 of them recovered in less than 6 months. And frankly, that surprised me as I really looked at the data. I thought the recovery times would typically be much longer, but a lot of these are very quick recoveries. In terms of the causes of the crash, and you look at how those are kind of divided up between the different causes as I define them, most of the time it related to concerns around global trade. And then it's pretty evenly distributed between the rest, right? The inflation rising or inflation and rising rates, algorithmic trading, contagion risk, and then market bubbles. When we look at what's the minimum and maximum look like by each of these causes. The bubble, which is, first the dot-com bubble, and then second, it related to the Great Recession, which is really the housing bubble, with a lot of, leverage issues there as well. Those really took a long time. I mean, 56 months. These are months, by the way. 56 months to recover for the Great Recession, and then it was really over 80 months for the market to fully recover after the dot-com bubble, which again surprised me. I would have thought that, with the bubble, especially the dot-com bubble, that it'd be, probably a quicker recovery. The Great Recession, I understand why that takes time to work through because there's a lot had to do with leverage and people being over leveraged. That deleveraging process can take a while. But bubbles have at least the two examples in the last 50 years have been the biggest impact or the longest impact, I should say, to the market. Um, when it dealt with inflation and rising interest, that was also one that stood out as taking a longer period of time to actually recover from, right? The minimum is 10 months, almost a year, and then the maximum there is 24 months. Um, Algorithmic trading was generally pretty quick, 5 to 20 months. 20 months was the Black Monday scenario in the 80s. And then contagion risk was 2 to 5 months, and global trade, concerns were 1 to 6 months. So there was some pretty clear, in granted, we only have 16 data points, so it's not like we have hundreds of data points, but when you look at them, I was surprised there really is some, I thought, pretty strong takeaways or some consistency in terms of recovery time based on whatever was causing the market crash to begin with. So that was pretty interesting. Before we get into the actual crashes themselves, are there any questions that you guys have about how I've looked at the data, how I'm defining the crash, or just any of these summary statistics that I just walked through?
How are you defining the recovery?
Good question. The recovery, I'm saying, wherever the market was, and then you have this 10% drop, how long did it take to get back to before that drop, before that 10% drop? How long did it take the market to get back to that level? And again, I'm defining the market as the S&P 500.
Hey, Robbie, can you define contagion risk again and what that is?
Yeah. So contagion risk. So this is like all 16 examples. Contagion risk here is,
Uh,
um, so like the Hunt Brothers silver crash, right? When the Hunt brothers were trying to corner the silver market, and then that whole thing ended up crashing. That's not, it doesn't necessarily have anything to do directly with equities, but it was a hugely disruptive event, and it did impact the markets. But so there's concern is how does that impact the broader market? Um, the red check here is a primary cause, and it's a couple situations like the Great Recession, high contagion risk as sort of a secondary check mark here, though this is, a bubble I said was a primary reason. The other contagion risk here is Brexit, right? Brexit didn't necessarily have anything directly to do with the equity markets in the US, but again, you kind of had this significant event that occurred, disruptive. How is that going to spill over into the rest of the world, rest of the market? Again, for this one, I had a secondary check mark here for global trade, just given what Brexit actually was. So that's well, that helps kind of give a little bit better of a idea of what I'm defining as contagion risk.
And back to previous slide, most likely you will talk about it. There is a clear trend between cause and how long it takes to recover.
Yeah. Yeah. I mean, it does appear when you kind of break it down by these buckets that there is, some trends here. Again, bubbles being clearly the longest. Inflation, rising interest rates also takes quite a while, which I think also makes sense because inflation just take a bit of time to work through the market. And then all the others, with the exception of the Black Monday event in the 80s, being relatively quick in terms of the recoveries.
So, Robbie, you looked at only those 1980 and beyond?
So this is the last 50 years. So starting in like the mid 70s and then through today.
Okay.
Frankly, when you start going for that. The data is not great in terms of collecting some of this, so
No.
yeah, I thought that was the best time frame to focus on. So as we look at each of these events, and I'll kind of talk briefly about each one of them, and then we can take a flip through to look at what the actual market performance was on a month-to-month basis. So in the late 70s, it really the period of late 70s and 80s was generally concerned about rising interest rates and inflation fears, and you'll hear people talk about how interest rates were in the teens. People complain about interest rates for a house being 5, 6, 7% today, which is nothing compared to what it was then. But still, it was a period of this was a period of time when there was definitely rising interest and inflation. Those fears started, or there was an impact in the late 70s, and again, it took kind of 10 months to recover from there. Um, Late in March of 1980, you had the Hunt Brothers silver crash, which was another sort of event, and then, but that occurred after the initial recovery from this 1978 situation, and then you had another period where the market crashed in December of 1980 with again the same fears related to interest rates and inflation and how persistent they were, which took about 22 months. Um, then you had a good period until 1987 where there weren't any market crashes. But then in October of 1987, you had infamous Black Monday. And Black Monday was really triggered by um, algorithmic trading. I mean, there was algorithmic trading even back then. When people talk about AI-based trading and high frequency trading today and how concerned people are about that, but AI trading has really existed for a long time. Not as accessible as it is today, right? Retail traders weren't doing AI-based trading in the 80s, but you still had computerized, based trading programs that were trading live in the markets even in the 80s. Um, and at this point in time of Black Monday, the market didn't have certain things it has today, like the circuit breakers, right? So the market crashed. I want to say it was like over 20% in a day, or it was something outrageous, and there were no stops set in place, right? Today, if the market drops by more than X%, literally all trading is halted. There's a period of time when no one is trading, and then it'll open back up, and if it goes down another X%, then they'll lock out the market again. But that was not true at this time. And a combination of it spooked the market about what can happen, and two, again, you had the persistent still concerns about inflation and the interest rate environment. So it did take a surprising amount of time to work through that, whereas sort of 20 months to fully recover from that event. Um, and remember too, we'll talk about this later. Retail investors were not nearly what it is today. Back then, so it was more institutional money at this point. In 1990, you had the invasion of Kuwait. This is sort of more of a. I had a separate category for war, but I ended up just talking about global trade. This is the only one that was kind of like a pure play war concern. Um, but that was about a 6 month recovery process. In the 1997, there was I think it was triggered by Thailand actually, but there was concern about the financial crisis in Asia specifically, and it kind of rippled throughout the world, U.S. included. Again, had a bad month in October of 1997, but it only took 2 months to recover from that. You had the dot-com bubble in 2000, where that took, it was actually, we'll look at it in detail, but there's only a 5 month recovery process from the initial drop, but then it continued to drop. And then at that point is over 80 months to really fully recover from the entire situation. We of course had the Great Recession in 2008, and the Bear Stearns collapse, which really triggered a lot of noise in the market, and that was a very long recovery process. In May of 2010, you had the flash crash, which again, this is defined as algorithmic trading, where they never really got a great answer in terms of what caused this. But again, it was really almost like a technical issue. There's no other fundamental issue causing the market crash the day that it happened. In August of 2011, the U.S. credit was downgraded, which concerned a lot of people, although the market recovered within 6 months. I needed to put a check there. Um, the U.S. credit downgrade, this was the contagion risk check, should be right there. Uh, in August of 2015, there was concern around China's deceleration and again, kind of what impact it have on global trade, although the market recovered quickly from that, 3 months. There was a Brexit feared in January of 2016. It was only a 2 month recovery. You had a 2018 flash crash, which again took about 5 or 6 months to recover from. COVID pandemic, which we are all well familiar with, took only 6 months to recover from. We had in January 2022, 2022 is when inflation really started to become more persistent and people became more concerned about what impact that would have. In combination, there was geopolitical risk, like mainly with Ukraine and Russia, and that took about really 2 years to fully recover from. And then, more recently in April, we had the launch of the tariff war, which was, only a 1 month recovery process. So as you kind of dive into each one of these in more detail, again, things that surprised me, one, that the bubbles have had clearly the longest period of time to recover from. And two, that the algorithmic trading events, which I would think would be like, oh, it's just like a technical issue, the market would recover quickly from, they're definitely not like the quickest recovery times. It usually took about 5 to 6 months in these cases, and then back in the 80s, it took much longer. Although there's some inflation and interest rate issues back then as well. But I would have thought that those would be much quicker recovery times. It was like, okay, it's algorithmic trading. It wasn't as fundamental of an issue, but people have gotten spooked as it related to those. So we're going to go through and kind of look at the actual trading charts for each one of these. But before we go on, any questions about the individual events or individual crashes?
Hey, Robbie, the criteria that you consider to come up with this list, 10% drop, whatever you said, it's over a period of few days or one day?
Looking at the month, looking at a
Oh,
30-day period of time.
okay. Okay.
Yeah.
Makes sense.
Yeah, and I'm looking at it that way because, again, for the core strategy of what we do with the double dipping dividend strategy, we're thinking about stocks, a month at a time. And so, yeah, that's why I chose 30 days.
Okay.
There's another discussion we had done. Well, it would have been in April where I looked at more like 1 or 2 day crashes. That one actually went back like 100 years, and it basically said the crash we had in April was actually a very significant event in terms of how far the market went down in those 2 days, and then again, it was crazy how quickly the market recovered from that. But yeah, this one was looking at 30 days. So we won't go through each one of these in detail. I'll share this so you guys can take a look at this on your own time as well. But what each of these charts look at is, for each one of these candlesticks represents a 30-day period of time, the calendar month. And starting with the month that you saw a huge decline. And it could either be that the market, the open and close was greater than a 10% loss, but it could also mean that you saw a greater than 10% swing when you look at the high and low, right? So for example, you can see there's clearly a huge decline in the market when we're talking about the 1978 market crash related to interest rate and inflation fears. With the Hunt brothers, there wasn't actually that big of a decline in the market. It was basically very close to even, but there was clearly a lot of volatility in that month, and so you could have been caught up buying here and then ending up much further down. So that's how I was looking at that. Um, for a lot of these ones here, like the interest rate in 1978, you saw there's a drop and there's a pretty clean and linear recovery, frankly. The Hunt Brothers crash was pretty similar, right? Like it's a very linear looking recovery process. Um, when you get into the inflation, right, and these are some of the more tricky recoveries in terms of length of time, you can see it's not quite as clean, right? It's not just a drop and then a linear curve up. Like it took a while for the market to kind of find its way towards the bottom. And then there's actually a pretty quick recovery, um, you know, after that point. But this one is a little bit trickier to deal with. So I guess and we'll talk about this a lot more when we get to the how to respond to the market. There's two concerns during a market crash. First, you're concerned about how far is the market going to trade down, right? Where is the bottom? How do I protect myself from the downward pressure? But then, and especially with what we're doing when we're selling options, you're worried about, well, now how quickly is the market going to recover? Because I want to be able to participate in that upside, but I also want to be able to use the cash I'm collecting when I'm selling call options to be able to mitigate further downside. But again, like we talk about a lot, if you enter a stock here and then you roll down your strike price to significantly below where we enter the stock, and then it recovers quickly, well, now we're taking a permanent loss, and we haven't given ourselves an ability to participate in that upside of the market recovery. So there's kind of these two things we need to keep in mind of how do we balance that out, protecting ourselves from the downside risk, and then making sure we're able to participate in that upside as the market recovers. The Black Monday crash, you can see how extreme, especially on a percentage basis, this crash was. It was pretty clean in terms of it was a relatively linear build back up for the recovery, but the market did not just bounce back immediately. It definitely took some time to get there. Iraq invasion of Kuwait, again, pretty clean recovery. There was 2 months of noise, came back up. Asian financial crisis. Um, there's only 2 months to recover from that one. There was some noise kind of later in the year. And then we had the dot-com bubble. So, this where you dropped initially in April of 2000, the market actually recovered within 5 months, and then you can see it just continued to slide down, even worse than that initial drop. And it took a while to find bottom, right? We're talking about from here, October of 2000, it didn't really find the bottom until October of 2002, right? So it was 2 years of pretty persistent decline. Not every single month, but that's a pretty it's a pretty tough slide down. And then coming back up, it didn't exactly rip back up immediately, but you definitely had some pretty good months of recovery, and then it was kind of slow and steady after that. Great Recession, this is probably the most violent of the market crashes in terms of length, the combination of length of time and how much you decline. Again, you have the initial big decline. The market's trying to figure out how real is this, and then it continued to get hammered. And these are some pretty scary drops. Again, went from trading close to 1500 all the way down to 700 within a little over a year. And then the recovery wasn't perfectly linear, right? I mean, it was like a pretty good build up, and then it kind of dipped back in 2010, and then it came back up. It dipped again pretty good in 2011, and then it finally kind of made its way back to recovery. But this is one where protecting yourself against continued downside risk would have been really important. And then, the recovery was probably a little bit easier to manage, which it actually started to recover. But these are vicious moves. And again, this is instead of a single month. Um, the 2010 flash crash, you see again the big decline, and then it came back up in linear fashion. U.S. credit downgrade, pretty similar. China deceleration was a very quick recovery again. But for all of these, unless there's a longer recovery for all these, I'm showing 12 months of price performance. So although it really only took 3 months to recover, I'm kind of showing what happened thereafter as well. Brexit fears, again, pretty quick, 2 month recovery, and then the market was pretty steady up. 2018 flash crash, similar. You had some other noise, occurring here in later in 2018. Um, COVID-19 pandemic, which we all probably remember well, as it was not that long ago. That was a vicious decline down, and then miraculously came back up. Um, and this was a V-shaped recovery that I think was pretty historic in terms of how quickly it happened. And I think this is really where we saw unprecedented government intervention in terms of supporting the recovery. I mean, there was, without question, government intervention, for example, during the Great Recession, where the government was helping to support and keep banks, keeping banks propped up and helping larger firms make their way through it. But we didn't see anything like what we saw during COVID in terms of, down to the individual level, some of the incentive programs that were out there for companies. It was just anything to keep the market going. Then we had inflation that started propping up really in 2022 in a larger way. And and on top of that, you had a Russia-Ukraine war, and that was again a slide down for quite a while in 2022. And then 2023 was definitely a climb back up. I remember this one pretty well though because as I was trading the strategy, the double dipping dividend, in 2022, I was almost exactly break even um, in terms of the overall uh, net account value for the year. I was really proud of that because the rest of the market was way down, and again, it's just a great example of how well this strategy can help protect against those downsides. So I was very happy. I remember thinking to myself, I've never been happier to not make any money because when you're flat and the rest of the market is significantly down, like it always kind of feels good, or at least you feel like you did something right there. Um, Launched the Tariff War more recently in April. You can see like again, it only took a month to recover from, but it was a crazy couple of days in terms of how the market reacted to that, and then it flew back up, and we're back to trading at all-time highs, which is kind of surprises me anyways. So anyways, again, you can kind of go through that in more detail as you guys want to after this. I will share this with you, but that shows you again kind of the shape of a lot of these recoveries. And a lot of the takeaway is when you go back and you look through, I think what you'll find is in most cases where there's kind of these single events, it's this sharp decline down and then a pretty steady climb back up. When you have these larger systemic issues like with the Great Recession, or things where inflation and interest rates really become an issue, that's where you have these more prolonged um, spirals downward, right? It's not this immediate drop and then recovery, but it's kind of this prolonged finding your way to the bottom. So, any questions before we go on to some of the key takeaways here? All right. So key takeaways, again, the market typically recovers from crashes within a year. And really, of the last 16 crashes, 10 of them took 6 months or less. In some cases, right, only 2 or 3 months. And there's only two crashes that have taken longer than 2 years to recover from, which was again the dot-com bubble and the Great Recession. And so as we think about that from how we respond, again, and we saw this with April, which worked well. I don't want to react too strongly when the market first goes down. I don't necessarily want to immediately just roll down my call options right away. Like I want to see what the market does for a little bit of time. Um, and that's for both how quickly the market can recover generally, but also um, because of some of these next points, crashes are happening more frequently. Now, in 2000, you didn't have as many defined, I guess, because partially it just took so long to recover from the crashes, right? It took 80 months for the dot-com bubble, then you had the Great Recession. And so, because of how long those are, there's only like there wasn't enough time for more crashes, I guess, within that decade. But you saw that there's been five between 2010 and 2020, and then we've had three already, I think it was, since 2020, and we're only basically halfway through the decade. So they are happening more frequently. We're also seeing how quickly these recoveries are happening. They're becoming shorter and shorter, and I think a lot of that has to do with the government intervention from both sides, right? Whether it was Democrats or Republicans in office, the government intervention, I think it's really become like not a political tool, but understanding that the perception of the economy is really important in terms of how voters are going to vote. Both sides want to make sure the economy is doing well, and look, I think it's very easy to argue that some of the things that are being done are not necessarily great for the long term. Um, I don't. I've not spoken to very many people that say, "Hey, it's great that we're printing a ton of money, and it's great that our annual deficit continues to be what it is, and that our the national debt continues to increase at the rates that they are." Right? Those aren't necessarily good long-term things to be happening, although some of those actions that are causing those things are good in the short term, maybe to stabilize the market and to help, whether it's the stock market or even just local businesses. But it is something that we're seeing, right? It's a fact that the government is intervening more, and in more profound ways in order to support the economy and the market. The other interesting thing that is relevant for today that hasn't always been relevant over this time period is how much more active retail traders are. So retail traders made up about 10% of trading volume in 2010. And today, they make up around 25% of the trading volume, right? And if you were to look back even further, the numbers, I don't have the data in front of me, but I know for sure if you looked in like the 80s or the 90s, like it'd be much less than 10%. So retail traders are becoming more and more relevant in how the market behaves. I read an interesting article very recently, I think in the last month. It might have been Barclays that came out with this, but just looking at fund flows and looking at how institutional investors are taking this much more cautious approach to the market and where the market is trading, whereas the retail traders continue to buy the dip anytime the market goes down, right? And even when you see some pretty sometimes concerning news events in the market, and the market will trade down, like it just as quickly will come back up, maybe in the same day or maybe in the next week, but the market has had this unbelievable resiliency where no matter what is causing it to go down, it just continues to float back up. And a lot of that, I believe, can be attributed to the impact of the retail investor. One, again, there's a lot of money out there. There's so much capital and people need a place to put their capital. They don't want it to just sit inside of a savings account earning, 4 or 5% a year. And so whether it's investing in things like crypto or the stock market or real estate or any asset class, right? Every asset class feels like it's, maybe not a bubble, but elevated for sure. And in the market, we've talked about this before. When I look at the S&P 500 and I look at what the implied PE multiple is, so not just what are the earnings that should ultimately be driving growth and increase in valuation or increase in value, but the valuation, like those same earnings are being traded at higher levels, has been a big reason for the increase in market caps and the overall value of the S&P 500. So it's interesting how that will continue to play out, how retail traders will continue to be able to support the market. And, what happens if there really is a trickier event? If, inflation persists, if interest rates really start to rise, if there is another bubble, right, that pops, will retail traders be able to shrug it off, or is it really going to have maybe an even more violent reaction than we've seen in the past? There's no way to answer that definitively, but it'll be interesting to see how that plays out. So there are several strategies in terms of how we respond to this. And again, we'll talk about this in a lot more detail next week, but the three broad buckets would be, you know, using structured option strategies to protect from these events. Um, whether it's selling our covered calls, whether it's buying put options, whether it's using call options to help, monopolize on what how a recovery might take place. Second broad category is thinking about rotating into specific sectors, right? So looking at what sectors do well, typically based on what the cause of a crash is. You hear people talk about rotating into more defensive names versus more risk-on names. AI technology, for example, being much riskier versus being in something more like a Walmart or a Target or, kind of a more basic materials kind of a company. And then lastly, portfolio allocation, meaning you know, if the market starts to get shaky, you're pulling your cash out of the market, you're waiting for the crash, you're trying to time when you're putting your capital to work in a particular asset classes. And so shifting your money around, just like how your money is invested. Um, and so we'll dive into detail for each one of these next week. But I want to pause there. But I've been talking a lot. What what questions do you guys have about what we just talked about?
So a retail trader is any individual that trades on his own. That includes retirement accounts and stuff.
Yeah, it doesn't have to be on their phone, but yeah, any individual investor, right? So not a mutual fund, not a hedge fund. It's an individual with an individual brokerage account. Like all of us on this call right now, we are all retail investors.
Okay.
What else?
When's the next market crash going to be?
Yeah. Who knows? It's a great question. I mean, I've told you guys this before. If I'm definitely conservative in terms of how I view the market. I'm more bearish than bullish. But if I had just been out of the market ever since I felt that way, which has been for the last, probably since COVID, then I'd be completely out of the market. So, I don't know. I'm definitely surprised at how resilient the market has been. I've been shocked by how quickly the market recovers from various events, but who knows? Um, yeah, there's definitely a lot going on, but there's a lot of, you don't have to think very hard about what could cause the next crash, whether it's something geopolitical with a war, whether it's, some of the things that are going on with tariffs right now. I think inflation and interest rates are definitely something that, could cause, potential issues. There's a lot of pressure to decrease rates right now, but then what happens with inflation? So there's definitely, you could pick your event about what could cause some of this volatility, but yeah, I mean the market is definitely feeling optimistic at the moment.
Hey, Robbie, a lot of people say historically September is a bad month for markets. So do you think next month being September,
Yeah,
this
I mean, people say that, and the back to school, and I've heard and read those same things. Like I'm sure there's some truth to it because of data. These are one of those things though where I think, how does it go? Like, um, I forget the term, but like causation versus like even though the data looks a certain way, it doesn't necessarily mean that September is a bad month inherently. So I don't put too much stock into it. I don't really let it change how I choose to trade. Um, but I know what you're talking about. I've heard and seen that as well.
Correlation doesn't cause causation.
There you go. Thank you.
Yeah.
Yeah, just because September typically has gone down doesn't necessarily mean that there's a reason for it. I mean, next year will definitely be an interesting year heading into midterm elections.
It's a technique, but in the way of market crashes, we option sellers, when and how we can switch to put to buy put.
Yeah. So that's going through the different crashes here, I think some of it depends on what caused the crash. So, for most of the situations you look at and you look at the shape of it, and again, it's kind of this 1 or 2 month decline followed by recovery. And the rate of the recovery might change, but it's pretty much, drop and then comes back. Um, there was a handful of situations where it's a much messier in terms of how it goes down. And so, in my opinion, especially with the double dipping dividend strategy, it's different if you have other option selling techniques where um, you're more focused on kind of account growth versus the consistent monthly cash flow. But the where are you going with this? When it just drops and has a slow recovery, that's relatively easy because I don't care what my share price is throughout the life of the trade. I only really care about what my share price is when I enter the trade and where it is when I exit the trade. Right? All the stuff in between is just noise. And as long as I'm collecting cash flows in between those 2 points, I'm cool. But so when it drops initially and then comes back up, no big deal. I just got to make sure that my call options are staying ahead of the price recovery. When you have those major situations like the Great Recession, the dot-com bubble, where there's kind of this continued, downflow for one of those causes, I think that's where you really need to think about getting protection either through puts or something else when the market is taking a bit of time to find the bottom. Now, it's obviously impossible to know right before you enter a crash when that's going to occur. Again, even if you um I remember talking about this with my dad before the Great Recession. There were certain friends he'd have on Wall Street, and like a lot of them like kind of knew or like saw this coming, and they knew the market was going to be weak. But it's one thing to have a prediction about what is going to happen, but completely different to know when it's going to happen, right? And the timing is everything. So again, I think it'd be really easy, fast forward 5 years, and the market has a major correction, for people to point to all the reasons why. Like I knew the market was going to be corrected. Like, there's geopolitical risk all over the place. You have all these tariff war. Like you could sound very smart about like, oh, I knew this was going to happen. How did people not see this coming? But again, if you're just not in the market for years at a time, then that can also be a challenge. So there's no way to. I think it's very difficult to get ahead of it. To time the market perfectly is almost impossible. But I think we can probably recognize when we start to enter a scenario where it starts to feel and look like a crash, trying to understand what is causing that, and based on that cause, and looking at some of the historical case studies, letting that help inform us how we want to adjust to those market reactions. So, and again, if we end up in something that's messier where the market's taking time to find its bottom, we're probably going to want to think about, well, how do we buy puts, or how do we do so in a strategic way, so that way as the market continues to decline, I can help offset some of that decline, whether it's through more aggressive management of our call options, rolling them down, or through again doing something like buying a put somehow to profit off of the downward spiral of a share price. Did that answer your question, Vladimir? Or?
Yeah, one of the technique can be used as a caller, selling call and use this money to
To
buy
buy the put,
put.
yeah. Yep. Yeah, that's one of the things
So
we're going to talk about next week.
yeah, so the worst case scenario probably neutral. If it continues to drop down, you have double benefit.
Yeah.
Hey,
Yep.
Robbie, if at all you are buying some certain puts as some sort of insurance under those conditions, that will also be for a duration of 30 days or longer, or
Sorry,
depends.
when you said buying calls or buying puts?
Buying puts.
You could do it. You could do it. We'll get into a deep dive next week, but there's several different ways you could approach that. If you're worried about very near term volatility, maybe even buy a put that's, like a weekly put. If something seems like it's stickier, more persistent, maybe you buy a longer term put. So there's a couple of different ways to approach that. But um, I think different situations will call for different durations of puts. I think the punchline there is, towards the beginning, you're probably looking at shorter dated puts as you figure out what's happening. And then as things start to stretch out longer, you're probably thinking about longer data puts, as if you get to a point where you feel like it's going to be some time for the market to really work through the price discovery, and finding the floor.
Okay.
Well, that's you guys, but your opinion is certainly equally as relevant as mine. Like, what do you think about the market? Do you think we'll see a crash in the next, call it, 12 months? Do you think, you know, you feel comfortable that that's probably not likely? Like, how do you guys feel about it?
I read something a couple of days ago, but it's talking about the super high valuations and comparing them to .com bubble valuations, which causes some concern. However, they were saying the difference is that a lot of those companies had completely no and hollow earnings, and actually the earnings continue to be strong. So in some way, support the valuations to a certain degree, so that if there is a reversal, it'll be a minor correction rather than a crash.
Yeah, yeah, yeah. I think the most, obvious and relevant parallel there is AI companies versus .com. Back the .com companies back then, where I don't think like a lot of the AI company. Well, I think a lot of the AI companies don't really have the earnings, or they certainly don't have the earnings to support the valuations today. But we'll see. I think we might have talked about this the other week. I had read something too where, and this is again happened during the .com bubble, where there'll be individual .com name that could certainly grow into their valuation, and you could justify the story on an individual basis. But if you looked at the cumulative valuation across all the .com names back then, like there's no way that the entire industry could grow into the aggregate value that it had been that it had been trading at. And I've heard it's similar today where you will like AI is definitely it's a huge disruptive trend. There are going to be a lot of winners from the wave of AI. But when you look at a basket of AI companies, like all the AI companies out there, and if you were to add up all their market caps together, it's becomes very difficult to justify the overall valuation, right? So again, within that basket of companies, you will have winners, but across the entire peer set, like it feels like there's got to be some sort of a correction there.
It's interesting too because it's like these companies, some of these companies that are, or a vast majority that are incorporating AI into their business models, which supposedly are gleaning some efficiencies and things like
Yeah,
that to support their. So yeah, I mean it's hard to pin down exactly, but no, I think you're absolutely right. There are, I think
yeah,
Palantir is a perfect example that like cratered just a couple of days ago.
yeah, yeah. The AI, and I was just talking about this with someone. There's a lot of companies using AI. There's a lot of companies that are leveraging AI to achieve efficiencies and to reduce workforce. And while AI has a lot of, again, very promising potential behind it, when you look at the quality or where AI is good and where it isn't, like AI is great for repetitive tasks. It's good when you're trying to get kind of a good enough answer, especially when you're talking about research. But it's not producing things, at least today, that are at a level that you think would be appropriate for a company that's trying to achieve like a very high quality of delivery or service. Um, but at the same time, despite that, there are a lot of very large companies that are seemingly it feels like they're becoming too reliant on AI too quickly because even though the level isn't there, they're still kind of like already going that direction. I'm sure part of it is there's a lot of pressure, and AI is a huge buzzword, right? There are so many. I mean, really, true AI doesn't really exist yet, right? A lot of this is machine learning, but AI probably triples or quadruples your value or more. So like a lot of people like to use the word AI to describe their product or their service. And I think similarly, companies have the pressure of being an AI enabled or an AI forward thinking company. And so they want to appear as they are really embracing and using AI in an intelligent way, maybe sooner than they need to. Right? I mean, it wouldn't be the first time that optics are driving, somewhat questionable decisions at larger companies that, might have a more detrimental impact longer term. So, and look, it's again, it's human nature. We tend to overcorrect or go too far to one side, and then we, find our way back towards the middle. I think that's what we're seeing right now with AI. I think people are over-indexing probably on how powerful it is today, and companies are probably overreacting to how much value they can get out of it today.
This call next year might be, you might have to add the AI bubble potentially to your worksheet.
Yeah, I could certainly see that being a future event. Yeah, I mean, as I think what could be the next crash. Um, and I don't want to sound like a doomsayer by any means, but looking at causes and what impact they've had, right? The two kind of worst types of crashes are crashes based on bubbles and crashes that have to do with inflation and interest rates. And on one hand, it's good that interest rates are not at like depressed levels, right? I mean, there's room for interest rates to go down. There's a lot of pressure for interest rates to go down, but you can certainly see inflation being persistent and tricky, especially with tariffs. If tariffs end up really kind of taking hold here, and again, like it feels like there's bubbles kind of all over the place. Uh, Crypto is trading, at crazy highs, and whether those again, really find their way to uh, becoming part of everyday life, or if crypto goes to zero like the other extreme says, who knows? But there's a ton of volatility. Like I think that's a fact. There's just a lot of volatility in the price of crypto. But a lot of people have a lot of money behind that, right? So that could really hurt some people if crypto crashes. Um, Real estate is softening right now without question, but real estate has, went on a crazy tear post-COVID. Again, you look at the stock market, and this gets back to what we were talking about earlier, and where valuations are. So forget about just company earnings growth, but there's been valuation inflation, not inflation, but valuation have been at close to significantly higher than where it is on average, and that could come down. So there's a lot. There's two tricky issues. One potentially with inflation, and two with bubbles. That if those really did cause a crash, it would be potentially a longer, more difficult crash to recover from. Then the question becomes, well, how does the government intervene, and how does that help kind of maybe mitigate some of that impact? And plus, you have the other dynamic of the retail traders being more actively involved, and that help with a quicker recovery. So there's opposing forces, which is again, no one has a crystal ball, and it's difficult to say what will happen. But there's a lot of forces at work in both directions, in my opinion. All right. Any other questions on either this topic or just any broad question you guys want to talk about before we wrap up for the night?
That's all great information. So thank you. Very well put together.
You're welcome.
I just
Well, wait.
had one question in relation to setting up the account for the first time. I'm using the IRA money. What percentage of the buying power is safe to use, considering there are things like market crashes?
Yeah, it's a good question. So the buying power is much different in this versus like other strategies that you look out, obviously with like the options on commodities that you've done as well. So like my buying power is usually like close to 100%. It's if because I am doing a retirement account, and because I'm buying stock and selling called against it, like I've got like it's always defined risk.
Yeah.
If I was doing something where I was using more leverage, like if I was selling um naked put options as like in the wheel strategy with leverage, then I would definitely think about how much buying power am I utilizing in that situation. But if you're doing a retirement account for your specific situation, and if your intention is to buy shares and then sell covered call options, then you can go and use your full account value, which is effectively what I do when you're investing. If
Okay,
you're
great.
nervous about the market and you just say like, look, I'd rather only use a portion of it, then that's obviously, totally fine as well. Um, but there's from like a protection, or how do I put it, like versus if you're doing a naked strategy or a strategy with risk, and you have to be very mindful about what percentage of your buying power you're going to utilize, it works differently for this strategy.
Okay, I thought so, but I didn't want to assume that.
Yep, no, it's a good question. Let
Thank
me
you.
ask you guys this before we get off. For each of you, what is one surprising kind of data point or summary that you took away from tonight's presentation?
That the April one was so short-lived, yet it was still a like 1-2 sucker punch for me. Like it really hit pretty hard. It was the first one I've actually traded through, like personally
Yeah.
traded through. So I kept trying to hang on, but my buying power kept getting eaten up. And I wasn't in this strategy, to be fair.
Yeah.
But that was what was surprising to me, that it was short-lived yet pretty impactful.
Yeah. Yeah, I would say
I
with
would
this
say
strategy, it was very smooth. Different, obviously, on the commodity side, but
Yeah, I
just
saw
smooth
your
and easy.
spreadsheet. I'm like, yeah, it wasn't even like any issue
I
at
couldn't
all.
even tell. Yeah.
Yeah.
James?
I was just saying I was surprised. I would not have guessed that the recoveries were as quick as they were. I would have expected them to be much more longer and drawn out and sustained.
Yeah, agreed. Spencer?
Just probably the chart showing the different causes and time frame for each one. Just seeing the big, fairly large difference between one or two causes versus the rest.
Yeah. Yep. Rajan, what about you?
Hey, Robbie, what surprised me was the .com and the Great Recession. So the amount of time they took to recover, like 55 months, 80 months, that sort of a thing, I would not have guessed that it took that longer.
Yeah.
So,
Vladimir, we were just going around before we wrapped up to say, like, what was your biggest surprise from tonight's presentation? Either some of the data points or just some of the takeaways.
Oh, which I already said, it's a clear trend between cause and how much it takes to recover. So if you correct what cause particular downshift in the future, you may estimate based on previous history, will it recover within 3 months or within 2 years or longer?
Yeah. Yeah. Cool.
This can be very important.
Yeah. All right. Anything else before we close it out for the night?
yeah,
All right.
found
Cool.
it interesting, Robbie. Thank you.
Yep, you're welcome. All right, guys. Well, we'll continue this next week. We'll talk more about how to actually mitigate and ways to respond. And if you have any other questions in the meantime, feel free to send me a message on Slack.
Good.
Thanks,
Thank
guys.
you.
Good night.
Thanks. Bye-bye.
Thank you.